the underlying cost to deliver that insurance from the life insurance company. The client pays for it through the premium, one way or the other. It can also, annual charges show up in the illustration. That includes cost of insurance, in BC, the 2% premium tax, and the annual policy fee. The premium is what the client pays, but cost of insurance is what it costs the life insurance company to provide it. Often when you get the policy delivered, you'll see, guaranteed rates or cost of insurance for the next, 20, 30, 40, 50 years. Expressed for $1,000 of coverage or death benefit per year. And that's kind of the unit cost of insurance. And that gets guaranteed to the client when they buy the life insurance. It's going to go up, but it's not going to, if they globally raise life insurance rates, they've locked in at what their cost of insurance is. And obviously as you get older, the cost of insurance goes up. It may appear to escalate exponentially in later years because the risk of dying is higher. So if you pay a premium, which is sort of an annualized cost of insurance for the next 10 years, an average of the next 10 years cost of insurance, and you pay a level premium, you buy term 10, the next 10 years is going to be more. So let's look at that. Okay, so annual renewable term. So these are kind of the different ways of cost of insurance. Annual renewable term has little steps. It goes up every year. Okay, and that's generally the basis for a permanent, the pricing of a permanent policy. We have two options in our UL, or three, but really two that we use. Annual renewable term, universal life, or level cost of insurance. Pros and cons to each, and definitely play with the illustration software on that. So annual renewable term is cheap when you're young, but in the background, it's going up every year. Now the client's premium may not go up every year, but the cost of insurance is going up every year. And it may not, if you just buy it as annual renewable term, not packaged in a permanent policy, it may not be available past 85. That actually is for term more. Usually we see annual renewable term as part of a permanent policy, but this could also be what you get when you have term insurance with an employer, right? It's the background, they're looking at the cost of insurance every year and paying that premium for their employees. Usually term is available in what's called level term. So although the cost of insurance is going up like that, they're taking the average of each 5-year period and charging a premium based on a 5-year term or a 10-year term. So now we're looking at the premiums. The premiums are going up every 5 or 10 years or 20 years, for example. So the amount paid, not the cost of insurance, is level for the term, but jumps up on renewal. Another type of insurance is called decreasing term. So it's the amount of insurance that's going down, generally used to follow a mortgage. And I think an IA now offers this for us, or they also have pick a term. So the benefit amount is going down, and so their cost is going down. So that can be good to follow a mortgage, but again, you got to make sure that their insurance needs are actually going down, right? Maybe the interest rates jump up and they start paying less of their mortgage principal, so you got to watch that. And return of premium term. I don't know if we really have a term product available. I haven't ever used it. But you can structure a UL so that they build up cash value and kind of get the cash value equates to the amount they've paid in term. So that would be a mildly overfunded UL. Does that make sense? Any questions on that?
So you're making back the premium through the rate of return on the slight.
Exactly. Exactly. So if you overpay, you pay more than the cost of insurance on a UL, right? That's how you get extra fund value. And I'm going to show you an easy way to present that concept at the end. Then that fund will grow, and depending on how much it grows, you can either have a lot of money there that you can withdraw, or you'll have a little bit of money there that kind of offsets the premium you've paid over the years. So two types of permanent insurance that I'm aware of, universal life and whole life. Whole life is typically not very flexible. So the premium's fixed, the death benefit is fixed, and the interest, there is some guarantees on the interest you'll receive. So and I'm kind of making generalizations, I'm sure there's products out there that are tweaked slightly different, but in whole life, the insurance companies have to guarantee a rate of return for the whole life, and so they tend to give a fairly conservative rate, and the cash buildup can be very slow. But the advantages of it are that it may allow an investor to diversify their investments, because the insurance company is investing that excess premium. And anyone know what insurance companies tend to invest in? Any ideas what they invest that premium in? One of the things is, yeah, they can invest in sort of long-term holdings, certainly invest in equities, markets, also commercial real estate. You see all the Manulife Towers, the Sun Life Towers, partly those are holdings or investments of the life insurance companies. What else can I tell you about that? Yeah, so for someone who's a well-diversified, sophisticated, cash-rich investor, they sometimes will buy a whole life policy just to, because they know that the life insurance company, they invest quite conservatively, it's kind of considered safe. It's another way for them to diversify their holdings and have an ability to cash in a policy and get some cash. And on the flip side, we often think of whole life as for our sophisticated investors, but not only. The one nice thing about whole life, it's very simple to manage. You sell a whole life policy, it's just like a mortgage, they pay their premiums as long as they can afford it. And, in 20 years it's paid up, it's not very, they can cash it in and surrender the policy and get some cash back. You're not worried about the performance of the underlying funds. On the other hand, in universal life, the investment risk is transferred to the policyholder. So in other words, the life insurance companies de-risked their investments. They've taken that investment risk, passed it on to you, the client. But you also get the investment reward. So it is generally a higher risk product because as an advisor or as a client, you gotta be watching what happens to those investments compared to what you've illustrated. And it's really important to do that annual review, download the statement and sort of check, are we on track? Your statement says that your fund value is X, that's half of what we thought it was gonna be, or it's double what we thought it was gonna be, so we're on track or we're not on track. So it's something important to have those conversations. Because the investment risk is transferred to the policyholder, it tends to be a better deal, right? The life insurance company isn't concerned about making more than what they've guaranteed to the policyholder on the investment. They basically have said, okay, the excess premium is up to, what you invested in is up to you. It's more flexible, right? And actually some products do have minimum guaranteed interest, so if my understanding of this, I'd love anyone to challenge me or correct me. Because on a 5-year term and a 10-year term, there's some guaranteed interest rates of returns. I think it's 1.25 over 5 years or something like that. But I think, my understanding of that is if the markets are negative, that you're not going to be eating into your, having your policy lapse. You're guaranteed as long as you cover the minimum premium, you're going to get at least enough on it to not be digging into your policy, right? So there are some guarantees, for example, Transamerica. But it's more complex, so you really need, stay on top of your UL policies with your clients, don't just sell it and forget it. Okay? And it has to be carefully set up. I find a lot of policies I've seen out there are not set up properly, they're not adequately overfunded. We're assuming 6%, which might happen over the long run, but we could have 3, 4, 5 years where people are not getting 6%, right? And at the beginning of a policy life, we've got to make sure it's going to survive that if there's a extended market downturn. Also, if you don't set it up with enough overpayment, in later years, you can see $12,000 to $24,000 premiums because there's not enough overfunding to offset the premiums. And you got to remember, if you sell it on a child, and if you're selling it as a cash withdrawal policy, you got to illustrate it. On the illustration software, you can go in and see what happens if you were to withdraw $20,000 at age 18 or 19. And you gotta make sure that that policy is still going to survive if they don't plan to surrender it. So get familiar on the illustration software. Does everyone know how to illustrate a withdrawal on the illustration software? Because I think everyone's licensed here, right? Make sure you find someone to teach you that, because that's what, things can look great if you don't withdraw money. But if you're selling it as a cash withdrawal policy or the ability, make sure you illustrate it and make sure that it's gonna be adequately funded. There is one philosophy out there: buy term and invest the difference. This has 3 really important assumptions. It can work, but generally it doesn't, because I find one is usually not true. People need to be disciplined enough to actually invest the difference. So if there's like, yeah, I'd rather do term and invest the difference, great, let's set up an investment, a tax-free savings account for you and make sure that invest the difference happens. And that has to happen through good times and tough times and good times. You know, I find a life insurance like a mortgage, and I'll tell my clients this. Life insurance, just like a mortgage, is forced savings. And people are like, oh yeah, I know, right? Like, it's forced savings. You have this kind of feeling, right? So that you gotta pay that first. But a tax-free savings account is very liquid. There's not a lot of consequences if you take the money out. So are they disciplined enough to do it? They also have to know how to invest. Hopefully with your help, that's not an issue. But often people will invest the difference. They put it into a GIC, put it into the bank, or buy a couple stocks, individual stocks. So they've got to have some help there. And thirdly, maybe they don't have tax-free savings account room left, right? So they're investing the difference in an RSP or a taxable open account. So in that case, investing within the UL may be better because it's tax sheltered and, unlike an RSP, accessible through a policy loan, tax-free. So looking at tax efficiency is important when talking about buying term, investing the difference. And by the way, the software illustration where it has that illustration for buy term, invest the difference, doesn't really do a good job of illustrating the tax consequences. It doesn't make the UL look as tax efficient as it can be. So it's not, I don't really like to use that sort of printout on the illustration.
Can you explain that a little bit?
Yeah. So there is an illustration, and I'm kind of going off my memory. I'll have to look at it more
I
closely.
just showed it yesterday, so.
Yeah. So I think it basically compares putting it into, I think it might be an open account.
So you can choose what the mixture is.
Yeah.
So I chose balanced, and then also put 100% into the deferred capital gains to illustrate what it would be like if you put it into a tax-free savings account.
Yeah.
I think that's the most tax efficient. So it
Yes.
does slightly beat the UL, but
Yes.
I was explaining to the client that it wasn't significant enough for it to be like you would buy term and then buy it into a tax-free savings account.
Yeah, if they put every cent into that tax-free savings account, but then once they run out of TFSA room.
Yeah, and then, so I was saying, but then my client who buys a UL can also buy TFSA.
Exactly.
You have 2 accounts.
Exactly, and that's a great way to show them the benefit.
Mm-hmm.
And I often say that too, it's like having another TFSA, you've got a bit more contribution room. A lot of clients, if you're selling a UL, hopefully they're the kind of clients that are going to have this problem of paying too much tax, right? They've got too much cash flow now or anticipated to. So it gives them an additional tax shelter. Yeah, you can set up, you have to just be careful, as Carla said, in how you set up the investment mix and the tax assumptions. When you use all the illustration software, it'll spit out a buy term, invest the difference sheet. But you just gotta look at the assumptions carefully on what they're saying with the tax rates and that sort of thing. And you want it to mimic a tax-free savings account or an RSP, for example. So often people will, if they invest the difference, they put it into their RSP. So then they're not gonna be further ahead. Yeah, no problem. It's important to talk to people about, as a segue into that, the tax advantages of a UL policy or a whole life policy. Tax-free death benefit. There's a lot of misconception out there about life insurance, and I guess in some countries the death benefit is not tax-free, but in Canada it is. As it grows inside the policy, inside the wrapper, it's tax deferred. You can have tax-free withdrawals up to your adjusted cost base, right? So it's tax preferred. So if you withdraw more than what you put in terms of cost of insurance, then you're taxed, but you're not taxed on the full withdrawal. Or you can structure it, is obviously the preferred way, is a collateral bank loan. So you can get a tax-free loan based on the cash surrender value of your policy. So that's the most tax efficient. But as I tell people, if you need the money in 3 days, you're just gonna do a withdrawal. If you've got, if it's a one-time thing, you might just do a withdrawal. If you're going to be doing a planned periodic withdrawal or an annual withdrawal, then it's worth it to go to the paperwork trouble of setting up a tax-free or a collateral bank loan, or if it's a substantial amount. But I always stress to people, unless you're really overfunding it dramatically, like think about this as sort of things you do in at least 10 years, not the next 10 years. So I always talk to people about just, you're getting this for now, you're gonna forget about it for at least 10 years, ideally 20, and it's gonna be more of a long-term source of, potentially source of income.
Absolutely. Two
Yeah.
questions. First question would be, could you explain a little bit more on what process would be to obtain a collateral bank loan? And two, I know this might be a stupid question, but what would be the implications if suddenly the government said that this wouldn't be a method by which they would, allow?
Yeah.
Is that even possible?
Yeah, okay, let's deal with that one first. So it's important to tell people, these are how the tax laws are structured now. It's quite possible that the government could shut that down, right? They have already ratcheted down a little bit on how aggressively you can put money in and take it out. However, you have to remember that the use of life insurance as a tax shelter, which has been around probably 100 years, is something that the wealthy and powerful tend to do. So I don't know that it would be wise politically for anyone to come in and shut that down when there's a lot of people that have built their retirement wealth on the ability to do this.
Okay.
And also a lot of people that are politically active, very, very wealthy, have done this. They don't tend to use RSPs, right? So it would kind of be political suicide to do it, but certainly we can't predict what's going to happen with tax law. By the same token, I think if the government is getting that desperate in terms of ways to find tax revenue, they're probably going to be hiking up personal income tax rates also, and anyone withdrawing from their RSP is going to be hit more heavily. So you got to kind of put it into context of what
So
it's
it's
like
not
to
something we should be really worried about.
I think it's always a consideration. Like, it's not something I personally worry about any more than I worry about income tax rates in the future. I mean, I do kind of worry about it, but it goes back to diversifying. This is why I say, have a UL, have some RSPs, have some tax-free savings accounts, because we may need any or all of them depending on what our personal situation is or what the government decides.
Okay.
So yeah, it's actually really good to make them aware that that's a possibility.
Maybe I'll-
Yeah,
Can I
go
add
ahead.
something? First off, how the government usually works is when they put a new policy in place, the only danger is making the UL policy no longer, or any cash accumulation, life insurance, to the environment not to be tax deferred anymore. But their practice is if they do that, they grandfather everything that already has been. Because it would be, I mean, if you made everything taxable, that would be like billions and billions of dollars that suddenly now that are in life insurance policies right now that would be taxed, and you would just be like, why would you do that,
Riots.
right? Massive. You would immediately know the government's just, I mean, so there's something wrong, like you cannot do that. So moving forward, then that would be perhaps, if they did do that, there would be no reason to do that, but if they did, as Allison said, one of the things they've done is lower the maximum. So you can't put as much inside life insurance policy, but they're still tax deferred. But the second thing is, like the collateral bank loan, there's not really anything they can do about that.
Yeah.
Because if you had a lot of cash, and you go to the bank, and the bank's willing to lend it to you, the government can't say, to discriminate against that loan and say that loan alone, whatever you pull out will be taxable. but it's still a loan, you're still paying interest. Loans are never taxable. So it's a pretty solid strategy that won't ever be affected politically.
I agree with Carlin. So what I was talking about was this withdrawals. And the government's more likely to ratchet down the people that are doing it as a blatant tax avoidance thing. Like, actually, my husband and I tried to do it, right? And we had warnings that this is probably gonna be shut down a couple of years in advance. Like, oh, we'll get 1 year out of it. So we got a policy, we put a bunch of money in, took it out right away and invested it. We're able to write off the cost of borrowing and then invest it in an open account and earn more than the 1 or 2% we're paying the cost of borrowing. And then it got shut down in end of 2013, which is fine. Like, well, we got it for 1 year. You know? So that's that. Tax-free loans, so the process is, for Transamerica, I don't know all the different insurance companies, but for Transamerica, they have an agreement with National Bank of Canada. And which basically means you call up, it's literally a 1-800 number. I've called them and I've said, I don't understand this collateral bank loan, I understand how it works. She goes, oh yeah, well this is like the collateral bank loan department. So they set you up, they hook you up with someone, I think it's in Montreal, and it's just like setting up a home equity line of credit. But you just gotta find the right people in the bank, and so Transamerica connects you up with the National Bank of Canada. And they sent me like a PDF of their loan terms. And you set up basically, it's just a bit of paperwork. Like it's, and you basically set up the ability to take a loan against the cash surrender value of your policy. And as you're lent that money, you rack up a tab, basically, of interest and principal. But the really, really key thing is that tab is not withdrawn out of your policy. So the full amount of cash value in your policy continues to grow. That's what makes a difference. Very different than an RSP. When you take the money out of an RSP, your capital shrinks and it's harder to keep up, right? So that's why this really works. And also, it's simple. Remember we talked about simple interest versus compound interest last week or the week before last? The policy loan is simple interest. Your cash surrender value continues to grow based on compound interest. And the loan, because it's a high security loan for the bank, they know you're gonna die, to be crass, right? They know eventually you'll die, they'll get their money. They're able to charge a very low risk rate. And it's based on the rate of, like the central bank, the rate of interest. Like right now, we're at a very low rate of interest. There's always gonna be a delta between a low risk investment, like a loan on cash surrender value, and higher risk investment, like investing your cash surrender value, even in a diversified fixed income portfolio or an equity or a balanced portfolio. There's always gonna be a delta. And that delta allows your cash surrender value to stay ahead of the simple interest paid on your loan.
Okay.
Sorry, I got a little bit technical there.
No, that's alright. So, okay, I've been hearing that basically my client can just take his policy, go to any bank and basically present it and say, hey, I wanna take a
Could be.
loan.
Yeah, it could be, as long as you find the right people, like if every bank will have someone that I'm sure does this. But it's just that Transamerica does have
Working
contractual agreement with National Bank that they will be the go-to bank and allow it.
I see.
I guess any other bank wouldn't have to do it. Yeah,
I spoke with Bank of Montreal, they also do it.
They also do that.
yeah, they love it. I'm sure they would love to be able to lend you money. Right? We know banks love to lend money. So I thought, but that's the end for now, and I think that will set us up. We already started getting into investments. We have just 2 minutes. I want to show you something that Ray wrote out for me, which I've always found very helpful. And even if you've seen it, hopefully you'll agree that it's helpful. Not that one. Can you see that? Yeah, okay. So Ray draws these in real time, so as not to overwhelm the client, but I'll just walk you through kind of how he talks about it. He says there's two types of insurance, term and permanent. And he says, term is generally available in 10, 20, and 30-year terms. You know, we can get 5 and that sort of thing. And he talks about the pros of term insurance. So he draws out, here's your age and the cost of insurance going up from age 30 to 100. And you average out the premium, the levelized premium for 10, 20, or 30 years. It's cheap when you're young. That's why people like it. And I don't diss term when I'm talking to people. Be careful not to turn them against term, because you're very likely going to sell them a policy with a combination of term and permanent. Or maybe in the end they don't want the permanent, and if you diss term, then you've just lost the sale. So you talk about it objectively. You know, the pros are that it's cheap when you're younger. The con is that it may only be available to age 85, and it can be very expensive as you get older. Another type of insurance is whole life insurance. You know, the pro with whole life is that it's permanent, and here's how it works. So he again draws out the same cost of insurance diagram from age 30 to 100, so that goes higher up. And he says what happens here is if your cost of insurance is, say, $50 when you're young in year 1, you're going to pay a premium of $200, and that extra $150 goes into a fund, which is generally used to buy more insurance in the whole life scenario. That's usually the best way to set up a whole life policy, is to use that extra $150 to purchase paid up insurance, because they're going to pay you dividends. You're going to hope they're going to pay you dividends based on the amount of paid up insurance. You can set it up in different ways, but this is usually how people set it up. And if that, after you've bought the paid up insurance, sometimes there's excess left over and it can go into an investment which can be used to pay you money. So this is generally how whole life is set up. And the pros are that the permanent insurance, insurance is permanent, there's a guaranteed death benefit, and you can get these dividends, and you can set it up to buy paid up insurance, or set up to be paid out in cash every year, which some people really love. But the cons is you don't have any control over how that money is invested. And by the way, that can be a pro for some people, right? They want access to different investments. But you don't have control over how the money is invested. And usually it's set up to buy more insurance, which may or may not appeal to people. For some people, wealth transfer, that sort of thing could appeal, but generally people aren't that excited about the money, excess money being used to buy more insurance. The third type, or the second type of permanent, and the third type of policy is called, universal life insurance. And this is kind of and I talk about how it was brought in when the cost of insurance, the cost of premiums for whole life policies got to be too big, and this kind of answered a need in the marketplace. So just like in whole life, you know, if the cost of insurance is $50 in the first year, we know it's going up in the background because we already talked to our client about how the cost of insurance works. But if your premium, if your cost of insurance is $50, you're going to pay $200, and that difference of $150 goes into a fund or into an investment, which you get to help select. And that investment will hopefully also grow and compound and pay down not only your cost of insurance in later years, but also provide a return, an additional return on investment. So the pros, you have control of your investment money, or more control, is permanent insurance, and you actually pay less. You can pay less for the cost of insurance because you can, in a way, self-insure. And so then he switches gears a little bit, and he shows them this graph at the bottom. The final thing I'll leave you with is this graph at the bottom, and it's very powerful. What we're looking at here is the age, but this isn't the graph of cost of insurance. So it's not this graph. What we're looking at is what's happening with this investment, with this money in the premium. So if you have a $500,000 death benefit, which is this straight line here, when you're 30, you know, the $150 you pay, maybe most of that goes to cover the $500,000, the cost of insurance on that $500,000. Maybe, well, we know that $50 of it does. The other $150 goes into this fund. So this line here, this line that curves up, is the growth of that extra 150 that you're paying, or that extra delta on top of the cost of insurance. So that's gonna grow. Say at age 50, you've built up $100,000 in your fund. Your cost of insurance is not based at that point on the full 500,000. Your cost of insurance is based on 400,000. So because the investment has grown, you're only paying for $400,000 worth of insurance. That's how, even though the cost for $1,000 of insurance is going up from age 30 to 100, the amount of insurance you're paying for is going down. It's being offset by your fund. So in a way, you're cost sharing with the life insurance company here, because if you died, they're only on the hook for 400,000. The other 100,000 is coming from your fund value to pay out the full 100. But at some point, hopefully it's not to scale, because hopefully it's long before 100, your death benefit and the fund value go up together. So that's where you have not only, well, there's two ways to look at it. You could say your death benefit's keeping up with inflation, or you could say, if you're not worried about the death benefit, you've got extra money in there that you can withdraw. You could withdraw almost like 90% of this, or borrow against it, if you don't care about the death benefit. So there's flexibility, there's reduced cost of insurance, but this is what's happening in the background. When you do those illustrations, and you see the fund value growing, you're seeing this fund value grow, and then you see weird things happening with the death benefit, the death benefit starting to go up. That will happen at different points depending on how much you overfund it, right? And you'll also see the cost of insurance going up and down. That's because the cost of insurance is based not only on their age, but the amount of insurance they're paying for, which is based depending on the fund value. I know it got a little bit technical, but since most of you said you're life licensed already, I thought I would go into that. If you're not life licensed, and this has just gone over your head, don't worry about it for now. Eventually this will make sense once you've gone through the LOQP, once you've gone out in some field training, and once you've seen it about 10 times. Okay, I think we have to wrap up now. So next week, I don't think there's anything special on the schedule for next week in terms of other events. So we should have this class at 8:30. I'd like to go into more on the investment side. What are mutual funds and bonds and stocks and capital markets, and start talking about that kind of stuff. Because now we're going to talk about what's in here. And we've also laid that, the first step in the financial plan is that foundation of life insurance. So now we can move up into sort of more the investment side. Make sense? Good. Well, thanks for getting up early on a Saturday morning and coming out to hear this. Let's get ready for BPM.
John Chan's the MC, and he's gonna be here in a few minutes, so, you guys just wanna help clean up the room, and then we'll get our meeting starting in about 5 minutes.